I'm Kelly Jennings, CEO of PowerBand Solutions. PowerBand is a cloud-based provider of auction, inventory, and finance solutions that make buying, selling, and financing vehicles more efficient. PowerBand Solutions trades on the TSX Venture Exchange symbol PBX and on the OTCQB symbol PWWPF and on Frankfurt symbol 1ZV. For more information, please visit us at powerbandsolutions.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. His website's PIFinancial.com and PolarFuturesGroup.com. Welcome back to the show, Drew.
Thanks for having me on again, Jim.
Drew, equity markets have had a very strong start to the year, and again, they were up this week. Is that going to continue?
Yeah, the equity markets, and the U.S. equity markets in particular, have been incredibly strong. I mean, we had, I think we're 10 out of the last 11 trading weeks have been up really since the Christmas time lows. This week, to me, it was the momentum names again, like we hadn't seen move. I mean, we've got the Apple stock alone up over 8% this week. The other FAANG names, Amazon up over 5%, Microsoft over 5%, Facebook struggling. They've got some of their own issues. And then some of the chip makers up very strong this week. So it was more of the momentum names that felt like they were dragging the other indices up, the other stocks up, especially the Dow being the big laggard, mostly because of the large component that Boeing has there, and the issues that Boeing is facing and has faced this week. So to me, this has been, a momentum push. A lot of the time we see these at the end of a strong move, but then again, we broke above some sort of key technical levels. The U.S. S&P market up to new 5-month highs, so going all the way back to the beginning of October when we first started selling off. So if I look to, is this just a momentum push and we're getting overdone? To me, I have to look back at a fundamental reason, and I'm seeing that the central banks really have turned. And, when we were going down at the end of last year, we were worried, the Fed was going to keep hiking rates. They hiked rates in the middle of December, and we didn't know if that was going to keep going, if they were going to keep doing their quantitative tightening. And since then, we've had, Powell came out at the beginning of this year on stage with Yellen and Bernanke telling us that, it was going to be okay. They weren't going to be raising rates aggressively. They could look at slowing and stopping QT, and they've laid sort of a groundwork for that as we go through this year. They've paused on rate hikes. So really it was, working against the central bank when we were going down, and now the central bank again sort of has the back of assets or equity markets. And last week we had the ECB come in and say, we're going to go back to TLTROs, which was, easy money for the banks to lend, and not going to raise rates anytime soon. They were supposed to raise rates this summer. So we're seeing a big shift in the sort of global central bank space to say, we're ready to continue the easing. We don't want to see any of this slowdown, pick up speed. And in that environment, it's hard to be short of the equity market. Equity markets will do better when you've got a lot of easy money coming in globally to keep equity prices higher, to keep asset prices higher.
Is that because people believe a healthy stock market means a healthy economy?
Yeah, I mean, we're hearing that, the stock market is now dictating how the Fed is going to act, how the ECB is going to act, rather than the economy doing that. And it's hard to say. I mean, it can be considered, the stock market can be considered a forward-looking indicator. Investors will try and price in what they see coming, not just what's happening right now. I still think we've seen a lot of our economic indicators showing that global growth is slowing. Global trade with the trade wars has been slowing. So the economy, isn't as strong as it's been, and yet our equity markets are almost as strong as they've ever been in the U.S., that is. So is it a true representative of the economic growth? I don't think so. But is it a true representation of economic growth with central bank stimulus on top of it? Yes. And I think that's been the biggest change has been we've now, after taking central bank stimulus away, we've now just recently in the last couple of months added a bunch back on again.
We'll have more with Drew Zimmerman right after this.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Grand Portage Resources recently completed the 2018 drill program on its 100% controlled Herbert Gold Discovery property located in the prolific Juneau Belt in southeast Alaska. Drill results are expected through late 2018. Past drill results included numerous multi-ounce gold assays on multiple veins. Grand Portage trading symbols are GPG on the TSX Venture, GPTRF on the OTCQB, and GPB on Frankfurt. For more information, please visit our website, grandportage.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, given the shift in central banks, what's that going to do to interest rates?
Yeah, again, with central banks going back to easier money, wanting to provide more stimulus to the economy, interest rates, even though stocks have moved back towards their highs, the all-time highs, we have interest rates a long way away from that. And actually, we had the U.S. 10-year today hitting 2.5-month lows on an intraday basis. So they're back to the lows where they were right at the start of this year. I mean, when stocks were at their highs last time, we had a high of 3.25 on the U.S. 10-year. We're trading at about 2.6 on the U.S. 10-year right now. So the last couple months, we've been in a 2.8 to 2.6 sort of range on the U.S. 10-year. But again, just to step back and take a bigger picture look at it, you've got equities returning to their highs, but yields are near their lows over the last several months, half a year. So, you've got some people saying, who do you believe? Do you believe the equity market that's marching higher, or do you believe interest rates as far as the strength of the economy and say, interest rates are near their lows, showing us that, the economy is not so strong. And I think, again, the only way to sort of make those positions equal is by factoring in the central banks. And the central banks have, again, sort of come out and sort of really strongly said, we are going to be patient. We aren't going to be moving rates higher. So then we get rates that, don't need to move higher. We had, a lot of expectations as we were moving into October last year that, the Fed was going to just keep marching along and quantitative tightening was on autopilot and we were going to get, 2, 3, maybe 4 rate hikes, through 2019. And now, we're pricing in a higher percent of an interest rate cut through 2019. So, I think that's the biggest difference. So I don't think we're going to see much higher interest rates. I think that if you were to start to see the market price in more of a Fed rate hike and you'd start to see interest rates rise again towards, say, 3% even on the U.S. 10-year, then I think you have the equity market starts to wobble again. And then it becomes sort of a self-fulfilling prophecy of if that makes equities start to wobble, then the Fed comes and steps back in. So I really do feel like we've sort of capped ourselves. I mean, we've had 9 interest rate hikes over the last several years in the U.S. Is this our new normal? Is this the new neutral rate, as high as interest rates are going to get? And it looks like that very well could be the case. So it's going to be lower for longer, I think, on the interest rate side of things.
We'll have more with Drew Zimmerman right after the break.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Drew Zimmerman. Drew, gold performed well at the end of last year as equities were selling off, but it stayed slightly higher even as equities moved higher this year. Is gold a safe hedge in case equities sell off again?
Yeah, gold had a good move. It was sort of the first full breakout with some strength above 1250 as equities were selling off in December. And then I think to a lot of people's surprise, as we moved through the beginning of this year, the first couple of months, gold continued on and traded all the way up to 1350, even though equities were doing better. So for me, even though you always hear about gold being a good portfolio hedge, if risk is happening in the world, people will want to own gold. I'm always looking at it as a function of U.S. dollar strength or weakness and real rates. So again, to go back to interest rates like we were just talking about, even though you've got equities moving higher, you've got interest rates near their lows. So real rates are going to be much lower, which helps gold do better. So even though we've had the U.S. dollar back near 97, I mean, it was just recently 97.5 on the Dixie index. So gold has performed well given some relative dollar strength, which is a good sign medium term for gold. But I think the more important sort of move for gold over the last several months has been real rates. So again, with interest rates, testing these lows, gold so far has held the 1280 level on this move back down from 1350. I'm really looking at the 1250 level here. Again, I think we could see rates going lower. So that's not going to be, that would, I think, sort of mitigate some U.S. dollar strength if we were going to see that happen. So I'm constructive medium term. I still think we could see a little bit more of a pullback. Like I say, I've got sort of a 1250 target would be a great level to get to, hold with, a little bit of strength over a few days. And then medium to longer term, I think it is a good play because I think, rates aren't going to have a huge move, I don't think. And move higher, that is, real rates. So if real rates aren't going to go too much higher and equities were to sell off, I think you could see some sort of risk-off trades come back into gold, but then also real rates helping gold as well.
Given that the U.S. dollar is important, what are your thoughts on the U.S. dollar in the future?
Yeah, we just hit recently and barely 18-month highs on the U.S. dollar. I think it's been a very strong currency given, again, a global environment of slowing growth. I think the U.S. economy has been able to hold up better than a lot of the other countries around the world. I think that's likely to continue. I think that even though the Fed has shifted from tightening to now just being patient, I mean, we're still in the process of doing QT, although it's going to end sooner than we thought it was going to otherwise. But again, still a central bank that is tightening a little bit and on pause more or less. Well, you've already had the ECB fully pivot going from wanting to tighten rates this summer to not tightening rates this year and going back to easy lending practices. That, to me, tells you that the U.S. dollar is still the strongest currency out there. I think we're likely to see the U.S. dollar continue to do better. And I think if this equity market was to roll over again, which I think it may sooner or later, again, this has been sort of a very strong thrust higher on a bounce back from the October to December move. But if we were to see that rollover, I think then you also have some safe haven flows into the U.S. dollar, given that you've got much higher yielding U.S. debt instruments. I mean, the German 10-year is hardly positive, so while it's a safe instrument, it's not going to give you anything, where the U.S. 10-year is, at least at this point, still giving you 2.6% a year. And if the U.S. dollar was getting stronger, you're going to get 2.6%. And if you leave the currency unhedged in a global context, you could win on the U.S. dollar trade as well. So I think it's very likely that we'll see the U.S. dollar trade higher if we take out the recent high of 97.5 on the dollar index, that the old highs are going to be in play, and that's sort of 103, 104 there, which implies, we could see the euro trade back down to 105, the previous low. So I'm looking for more U.S. dollar strength. It's showing me on the chart that we've continued to put in higher lows and make new highs. So until we see a strong trend change on that, I'm going to continue to hold the fundamental view that the U.S. dollar is heading higher.
Oil also performed well after the Christmas lows. What's your outlook for oil?
Yeah, oil and equities were trading very much hand in hand. They both had highs in October 3rd, and then both made their lows at Christmas time, and then both moved higher. I think oil, rather than being a function of central bank pivots, I think has been more a function of OPEC pivots and OPEC and Russia together. So we've had a large increase of U.S. production. I mean, the U.S. Recently just made new production highs at 12.1 million barrels a day, which is significant. The U.S. definitely seems to be on their way to energy independence. But to offset that, you had Saudi really leading OPEC to say, we're going to come in with production cuts, and we're going to, stabilize this market. So not only was Saudi cutting their production dramatically, but you had the involuntary production cuts with the sanctions going against Iran. We've got those waivers that were the U.S. granted to 8 countries that are good until April. They're in talks if they're going to continue those to give out those waivers again. If not, then there's some more oil coming off the global market. And then, of course, the sort of implosion of Venezuela has really taken a lot of barrels off the global market as well. So you've had U.S. production sort of getting bigger and taking more market share. OPEC, both voluntary cuts and involuntary cuts, scaling back. So that's helped a lot of the inventory numbers, and just the whole look of where supply and demand is going to be near term. We're going from an oversupplied market to a more balanced market. So I think that's really helped crude get back to this level. At the, close to $60 level where we are now, I think you do have a lot of incentive for the U.S. to keep and possibly build more production. And, if the OPEC member nations and then the non-OPEC, Russia, and so forth, see this as, a reasonable price level, do they want to continue to curtail their production, especially if they're giving up market share to the United States? So, I think we may start to see oil get capped. I think this run higher, not only has it helped that equities have run higher just as far as risk psychology in the market, but the sort of oil-specific things with supply and demand have helped it get to this level. But again, I think, at the $60 to $65 level near term, I think we're capped. And we also did have Donald Trump come out at about, I think it was around $57 again, saying, OPEC better let some more oil flow. We don't want to see oil prices go too high. He really sees that as a tax on his country, because all the consumers have to pay higher gas prices if oil is going higher. So if we move much higher, he may become more vocal and try and apply a little more political pressure on OPEC, on Russia, to say, hey, you've got the supply there. Let some of it back onto the market. Let's keep oil prices lower. That does everybody a favor for global growth. It makes it a little easier. So, well, we've had a good move. We may be running out of steam to the upside as we get to these higher levels.
Given your view on oil and the U.S. dollar, what's your outlook for the Canadian buck?
Yeah, both of those very key inputs to my Canadian dollar forecasts. Also, I look at interest rate differentials. So, the interest rate differential between Canada and the U.S. on 2-year paper is out over 80 basis points. So almost an extra percent for holding U.S. 2-year paper instead of Canadian 2-year paper. That's at a 12-year high. So again, I think there's just more flow, more desire to hold U.S. treasuries instead of Canadian paper. So that will drive some flows. I still think Canada fundamentally has got several things working against us. One is, of course, the energy infrastructure, to be able to move any of our energy, especially with the Venezuela outage that we've seen over the last several months. It was sort of a golden opportunity for Canada to provide the Gulf Coast refiners with our heavy crude that they were going to be missing from Venezuela. But again, we just don't have the infrastructure capacity in place to be able to take advantage, which is unfortunate, and still we don't seem to be making any sort of headroads into getting that done, which is unfortunate. We see our housing numbers continue to slow in the hot markets, Vancouver especially, Toronto coming off a little bit as well. So real estate has become incredibly important, not only in the construction aspect and all the other spin-off industries that come with that, but the high amount of debt that Canadians have, a lot of that tied to real estate and or loans on that real estate. So if real estate continues to slow, I think that will have a knock-on effect on consumers, consumer confidence, consumer spending, which again then sort of trickles back through overall. So we've had some weaker economic data as we went through the end of last year. It'll be interesting to see how we play out in the first quarter. But again, if oil were to cap out at these price levels, that's going to stop, helping the Canadian dollar do better. If the U.S. dollar does better, it is the big dollar. It will put pressure on the Canadian dollar. And again, if our internal economic situation doesn't start to look any better, then you've got the central bank in Canada also now being patient, maybe looking the other way towards easing or, again, just staying extra patient, which would then, drive interest rate differentials further in the U.S. dollar's favor. So altogether, not looking all that great in Canada. And then, of course, we're going to be heading to an election. And right now, Trudeau still struggling, I think, with some of the S&C blowback. So, a little bit of political instability on top of it isn't doing the Canadian dollar any favors either.
Drew, thank you so much for chatting with us.
Thanks for having me on again this week, Jim.
My guest has been Drew Zimmerman, Derivatives Portfolio Manager at PI Financial in Vancouver. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet. If you have any questions for our guests, like Drew, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.